This is Adam Thurgood of HighTower Las Vegas, and welcome to our Spring 2019 client briefing. The past several quarters have been interesting, to say the least. We've seen some fairly dramatic swings in momentum in the markets that have left a lot of investors feeling like they're a ball in the financial tennis match. So we titled this presentation Game, Set, or Match to relate to that feeling, but also to pose a bigger question of whether or not this business cycle is over. Now, from a historical perspective, there's no question that the bulls tend to win more than the bears. The economy tends to grow more than it contracts. And if you look at any long-term chart of the S&P 500, you'll see that it's demonstrably higher. That's because companies tend to produce profits and efficiencies over time, and the market tends to relate to profits in a meaningful way over a longer period of time. But that's not to say there aren't periods of volatility along the way. We saw one such period in the fourth quarter where the S&P 500 fell 20% in the matter of just a few weeks, only to rebound significantly and get back to all-time highs just 4 months later. So a lot of investors have been wondering what happened in the fourth quarter that caused everything to change so rapidly. Well, simply stated, we have conflicting economic forces at play. And economics is always a bit of comedy and tragedy. There's never a clear direction in one way that is so absolute that you could never make an argument that things need to slow down or accelerate. That's why Harry Truman once demanded that he wanted a one-handed economist. He was tired of hearing, on the one hand, things are great, and on the other hand, they're poor. He just wanted a clear picture. And unfortunately, in economics, that's not always the case. It's not always easy to come by. There are always positive and negative forces at play. And when the market shifts its focus between the positives and the negatives, that creates volatility. And that's what happened in the fourth quarter. The Fed's messaging caused market participants to focus on the negatives, and suddenly we were in a vicious cycle where selling meant more selling. Now, when we look at the economic data today, we can clearly see two sides to the story. On the positive front, the labor market is incredibly strong. The unemployment rate is under 4%. People are back to work. They're having fun. They're in jobs that feel much better to them than they did in the past. And that can be expressed by looking at the underemployment rate, which is a rate that measures underemployment. It looks at things like whether a worker wants to work full-time and can only get a part-time job, or whether somebody has a master's degree in engineering and is only flipping burgers. And when you see an underemployment rate where it is today, it's a sign that the labor market is tight and finding quality high-skilled workers will be challenging. Now, the way that you do find those workers is pretty clear. You pay them more. And that's why we've seen average hourly earnings really start to surge over the past 12 months or so as the labor market has become more tight. Now, average hourly earnings on the rise to respectable levels is good for the economy long term. It's a little challenging for corporate profit margins in the short run because you need productivity gains to offset those higher wages. But having more money in consumers' pockets is a positive for the economy in most cases. Now, it's no wonder that consumer confidence is so high when the labor market is strong and wages are rising. And while consumer confidence has declined a little bit in the past few months, it's still at levels that we haven't seen consistently since the 1990s. So we have a very confident consumer that's got more money in their pocket, and consumption is such a big part of our economy that this has to give anybody that's looking at it at least some reassurances that we're not ready to fall off a cliff like we were in 2007 or 8. Now, love him or hate him, President Trump has been very pro-business from a regulatory perspective. Prior to President Trump, President Clinton, Bush, Obama all had relatively similar track records for increasing regulation. But under Trump, that has ground to a halt. It's basically non-existent today. And a lot of people believe that the market surge in 2017 was as much about the regulatory change in tone as it was about anticipated tax cuts. Now, we could go on about positive forces, but we don't want to keep you here all day. So let's stop here for a second and focus on some of the negatives that are starting to permeate throughout the markets and people's minds. One of the big ones is the big one. It's our national debt. We have over $22 trillion now, which is just a number that's so large it's hard to comprehend. One of the best ways that I've seen or heard on how to put this into perspective is that if you go back in time 1 million seconds, you're about 11 to 12 days in the past. If you go back in time 1 trillion seconds, you're at about 30,000 BC. And we have 22 times that impact in debt sitting on our national balance sheet. So this is a big number. Debt is a concern whether you're a government or an individual. Now the US is in a position of envy because we are the world's reserve currency, the dollar is, and that means that people need to own our debt and own our currency. But some of the trends that we've seen with purchases, such as China's declining trend in purchases, Russia's basically non-existent in purchases now, raises a bit of concern because that means the rest of the world has to soak up the excess supply that we're bringing to market. And because of our federal budget deficits, we're bringing a lot of supply to market on a regular basis. Our federal deficit is projected to be somewhere between $800 billion and $1 trillion per year over the next several years. This is being driven by tax cuts, by entitlement spending, by really an inability of Congress to cut costs in any meaningful way. And these large deficits are only going to add to our debt burden over time. And that's problematic. Eventually, the world will demand higher interest rates for greater risk in our overall financial situation. Now, the budget deficit isn't the only deficit in town. We have a large trade deficit. This has obviously been something President Trump has focused a lot on. We actually run a trade surplus, meaning we send more services abroad than we bring in. But when it comes to goods, we're running a very large trade deficit. And while this is perhaps, and I think you could make an argument that it's necessary if you want to be the world's reserve currency, it's certainly not going to sit well with President Trump, and that raises the odds of further trade action. And I love this cartoon because I think it speaks pretty clearly to how a lot of people feel that are dealing with international business. The tariffs and the trade war with China have really created a lot of uncertainty and angst, and it's been difficult to do business in this type of an environment. We've seen worldwide trade come down quite sharply. Now, it looks like a trade deal is perhaps going to get done. One day it looks fine, the next day Trump is tweeting that he's going to put tariffs back on. So it's hard to say for certain, but assuming that the trade deal gets done with China, there is still a possibility that President Trump will look to basically Europe to try and get some concessions from them as well. And I'm not sure that the market's going to respond too well to getting into a trade war with our largest ally and most important ally. So in this environment, you'd think the economy is doing very well and debt levels are on the rise, that you'd have increasing interest rates. But we actually have declining interest rates, and in a meaningful way. Rates have actually plunged so far in 2019. And why is that the case? Why is the bond market telling us a different story than the stock market? The bond market is basically saying, wait a minute, everyone, we should be cautious here. Things are not looking nearly as rosy as the stock market is saying that they will turn out to be. Now, the two markets can disagree. That happens all the time, and while the bond market is said to always be right, that's not necessarily true. But the one thing that concerns us a bit is some of the areas of the economy where you tend to see a positive bounce from lower interest rates just isn't happening so far in 2019. Prices for single-family homes have been in decline for about a year. They're not seeing a dramatic pickup from lower interest rates. Typically, lower rates mean that people can buy more house, and that creates some more demand in the marketplace, but lower rates really haven't helped housing starts or single-family home prices. They really haven't helped business optimism either. Optimism has plunged over the past few months, and this is important because the way business leaders feel about the economy will impact their spending plans, and that capital investment is critical to keeping productivity growth moving in the right direction. You need productivity growth to offset higher wages and to keep inflation in check. Otherwise, you have declining profit margins both in nominal and real terms, and that's a problem for the economy and the stock market. So there are so many positive and negative forces out there. What does it all mean? It's no wonder that a lot of people are left scratching their heads. So when we put the pieces together, what we see going forward is a slowing but still growing economy. One that is not going into recession, but is also not growing at a pace that's going to feel awesome. If we look back at what's happened over the past 10 years or so since the financial crisis, we've never really gotten to that breakout velocity where the economy was growing at 3+% for a consistent period of time. It's kind of been in that 1.6 to 3% range. But over the past 3 years, we've seen a steady uptick in economic activity. But when we look forward, it looks the other way. It looks like we're going to tick down over the course of the next couple of years. So we're not going negative. We don't believe that's the case. It's certainly possible if animal spirits turn in the wrong direction. But right now, it looks like from an economic forecast that GDP will stay positive, but it will just slow down and maybe won't feel great, but it doesn't look like we're headed for a dramatic pullback in economic activity. And this is what's called a soft landing. It's the process of an economy shifting from growth to slow growth, even to potentially flat growth as it approaches but avoids a recession. So it's somewhat rare to see a soft landing that holds, but we think that the environment is right for a soft landing because we have lower interest rates and we have a Fed that is now supportive. Now, one of the byproducts of slowing growth is that earnings growth will probably slow down. Earnings have been phenomenal over the past couple of years as a result of the tax cuts and just generally stronger economic activity, but we expect earnings growth to slow. And if you look at the chart here, it's showing with the gray bars what earnings growth was in any given year. You can see in 2017 and 2018, double-digit earnings growth, but projected the year-over-year gain or loss for 2019 has actually been negative. We're down about 4%. Now, the gold circles represent the S&P 500's return in those years. And it's no wonder that in 2011 and 2015 that you saw a stock market that didn't really do much when earnings growth was kind of flat. But in other years, when earnings growth was north of 5%, you saw a market that tended to do pretty well. Now that changed last year because the fourth quarter was such a dramatically negative event that despite having a very strong level of earnings growth, we saw a negative return in the markets. But if we look at this chart and put it into perspective, we probably see a flattish market this year going forward over the next 12 months, just given what's happening from an earnings perspective. But that's not the only thing we need to consider. We also need to consider other factors. Now, one of the main things that we always look at is what's going on with the economic cycle. And sure, we believe we're in the latter stages of the economic cycle, but it doesn't necessarily mean that we're about to collapse. The economic cycle is always the biggest beast in the room. It's much more important than the bull or the bear trend in the market because the economic cycle is what it is, and it will dominate everything else when the time comes. Now, we don't believe that the Fed has abolished the economic cycle. We just think that it's been extended given the fact that we have very supportive monetary policy and we never saw escape velocity in economic growth. Now, the Fed is definitely in a more supportive place today than they were in the fourth quarter. They've stopped raising rates and they've decided that they're going to cut back the amount of bond sales into the market. So that is definitely a positive for the S&P 500 and the economy. It's going to be more supportive of the economy in general. And the markets are paying very close attention to what the Fed does, perhaps more than ever. So with a supportive Fed, you have to think that the odds are that the economy will continue to do okay. But it's worth noting that the Fed usually gets conservative and dovish when the economy is not doing so well. So the messaging that we took from what happened in the fourth quarter with the Fed flip-flopping is that, look, things are okay, but they're not as great as everyone would believe. So you have to consider both sides of the story, but at least with a more positive Fed, at least from a stimulus perspective, it helps to put some support underneath the market. So where are the opportunities? We've talked a lot about the U.S., and in the third year of a presidential cycle, the U.S. market tends to do much better than average. This is typically because the market is, or the president is trying to do all they can to get the market and the economy heating up as they head into that critical fourth years when they're looking for re-election. And this has sort of played out so far this year. Some of it is due to the fact that we had such a poor fourth quarter and we were starting at a low base, but certainly President Trump, from his messaging, wants the Fed to lower rates and do more to stimulate economic growth, and that's simply driven by where we are in the presidential cycle. He doesn't want a recession coming in the fourth year of his term, otherwise he has no chance of getting reelected. So it's no wonder that the markets tend to do well in the third year of a presidential cycle, and that's exactly where we sit today. Now, from a valuation perspective, the U.S. stock market is a bit overvalued. It's not excessively overvalued like it was in prior periods, but because earnings growth was strong last year and the markets had a negative year of performance, the overall level of valuation in the market has come down quite a bit, and it's no longer at a point that really is terribly concerning. It's not as cheap as it's been in the past, but it's also not at those really extreme levels like we saw in the 90s and a little bit in that 2017 period. Now, internationally, valuations look to be a bit better. The developed markets, which are your European markets, Canada, Australia, Japan, they appear to be a better value. Part of that is due to the fact that their economic activity has trailed that of the United States. But if you're going to take a long-term point of view, these markets look like they have value to offer investors. Emerging markets are another place where we see better valuations. Overall, multiples there are quite a bit cheaper than they are in the U.S., and that's where the growth rates are coming around the world. Growth is being driven by those emerging markets. China, largest contributor to world economic growth. India is number 2, and a lot of other emerging markets are really important players now in overall economic activity from a global perspective. We think that having more exposure to these areas, given the dramatic outperformance in the U.S. over the past 5 or so years, and the valuation levels of the two areas being so different, that it makes a lot of sense to have exposure internationally. Now, one thing that investors ought to keep in mind, whether you're investing here at home or globally, is that despite the market tending to do better in most years than worse, and despite the fact that you're going to have a lot of years that are positive relative to bad, that doesn't mean that there isn't pain along the way. These blue dots here represent the drawdown that was experienced in any given year, which is basically where the market was at its peak to its low point, the largest decline that you saw throughout that year. And these are significant numbers. I mean, most of them are in that 10% range where you see the market fall at least 8 to 10 to 12% in a given year, but the purple bars are what the overall return was for the year. And only in a few circumstances did you see a negative return for equities. But during that period of time, you saw some significant volatility and a drawdown that was probably pretty scary. This is the reason that equity investors get rewarded more than other types of securities, because there is more volatility along the way. There's more risk along the way. And in order to achieve higher returns, you have to be able to stomach these ups and downs. So we think that having a globally diversified portfolio, having the right amount of fixed income that rounds out your asset allocation, having some exposure in precious metals and cash makes a lot of sense, because over time you'll be able to achieve the returns that you need to satisfy your financial plan if it's well constructed and you stick to it. So we're happy to take any questions. Feel free to give us a call. We appreciate your time today, and we'll see you next time.